check.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
Good morning and welcome to the show. Of course, it's the second best day of the week, which means Michael Leibowitz is joining me today to talk a little bit about the FOMC minutes yesterday and, of course, Jerome Powell's speech tomorrow at the Jackson Hole Summit. So we'll kind of go through all that data as we get there. Of course, the big news yesterday that we didn't get to talk about because it came out late, really late yesterday, was the revision to the jobs report, which was very interesting. So first of all, it was supposed to so understand that banks and major institutions all around the world look at the data that is produced by the government and they trade off of that. So when data, and again, everybody's focused on when a release comes out, their computer algorithms, everything are tied up to those data points. And so if the data is delayed for whatever reason, that causes all kinds of potential chaos in the markets because these computer algorithms are looking for this data on a specific release time. Well, that data did not get released until very late yesterday. It was a little bit more than half an hour after the official release date. What was interesting though was that everybody started, of course, all these major banks that are waiting on this data, they start calling the BLS looking for this data. Well, every now and then they would pick up the phone and selectively release that data to certain players while everybody else was waiting on the data, which obviously kind of gave a bit of an advantage to some traders over others. But eventually that data was released yesterday at about 10:34. Very late, and of course lots of upset people about that, but it showed a negative revision of 818,000 jobs over the last year. Now, if we take the last 2 years of revisions, that is 1.1 million jobs that we supposedly created that didn't really exist. Again, this is just the problem with a lot of these estimates, and we talk about all the time these mathematical adjustments and the birth-death adjustment, which isn't even close to being realistic. But that's what creates these overstatements. And we have talked about before is that we would eventually see these negative revisions to the data. And yesterday's negative revision of 818,000 jobs is the largest annual revision going back to 2009 following the financial crisis. Now, again, this data will get revised again in 3 years. So we initially released the data, we revised the data in a year, we revise it again in 3 years. So again, even these numbers may still be overstated. Now, this revision went through March of this year. So the most recent set of data, April, May, June, July, August, that is still set for revisions next year. So again, we may be still overstating a lot of this data. But interestingly enough, the markets really kind of looked at the data for the most part and then kind of shrugged it off and went, okay, that's fine. We kind of know what it is and traded from there. Markets actually finished modestly higher yesterday. But again, that was the big news yesterday. And we've talked about for a while, look, all the economic data. And Mike and I have written articles about this. We've talked about this on the show. All the economic data suggested that job growth was a lot weaker than what these headline numbers were suggesting. And we've talked about the gaps between the seasonally adjusted and the non-seasonally adjusted data. We've talked about the differentials between temp hiring versus full-time hiring. We've talked about the problems with the JOLT survey, which is the job opening and labor turnover survey. All of that data suggested that the employment with data was actually a lot weaker than expected, and now we know exactly that it was 818,000 jobs weaker than it was. But that was the big news. That was really kind of the big news yesterday. Again, it's interesting because everybody kind of knew this was coming out. Like, we knew we were going to get the revisions, and everybody's like, oh, when we get this revision, the market's going to tank because it's going to be so terrible. Markets don't care about revisions, and this is really an important thing to remember. This is really two of the big fallacies that investors do wrong when managing their money. First of all, they worry about other stuff that we can't control, right? So again, the markets don't care about what your personal inflation rate is at home, right? That's you and what you're dealing with at home. Markets don't care about that. What markets care about is the official release. That's all the market cares about. So don't worry so much about your personal views on the economy or inflation or whatever it is, because the market only cares about the release of the data. Secondly, the markets don't care about revisions. Markets are forward-looking. I'll spit that word out. Forward-looking, and so these revisions, we get revisions to data all the time. Markets don't care about that. They're looking forward. Okay, that's fine. That's the rearview mirror, and here we go from there. There's a great scene in the Gumball Rally with about Italian driving, and the driver, I think it was played by Raul Julia, was the Italian driver in the Gumball Rally. He reaches up, grabs the rearview mirror off the car, throws it out the back, and says, "What's behind me is not important." That's the first rule of Italian driving. And this is kind of the same thing for the markets. Markets don't care about what happens in the rearview mirror. But nonetheless, the FOMC minutes came out yesterday stating that it would be appropriate for the Fed to cut rates come September, and the bond market actually liked that pretty well. So the negative revisions to data, weaker economic growth, and the FOMC minutes have continued to push interest rates higher here, or lower here, and of course bond prices higher. Now again, we've talked about before, bonds are extremely overbought here. So again, it's going to be very tough for investors to buy bonds here. You have to wait for some type of pullback in the markets. So here's what you need to know before the bell this morning. In particular, the S&P is approaching its all-time high. There's a good bit of resistance right now that we're about to run into. Again, the markets have been up now. This is one of the strongest runs in the last couple of years for the markets. The NASDAQ is up 11% in 10 days. That's a very, very strong rally in the markets. This has been just a V-shaped, and talk about V-shaped recoveries. This is about as V-shaped as you can get in the financial markets. We're getting decently extended now above the 20-day moving average, getting fairly extended above the 200-day moving average again. Markets are back to overbought. Again, I know there's a lot of exuberance in the markets right now. Corporate buybacks really doing the bulk of the work here for the markets over the last 10 days. But again, this is not a time here particularly to chase stocks. So again, as we've talked about before, that this is all bullish. The bullish trend remains intact. There's nothing wrong with the markets. There's nothing to suggest a bigger correction is coming. No reason to be real negative on markets right now. Everything about the market, from bullish thrust to the improving breadth, etc., all suggest that markets are going to move higher from here, not lower. So, but that doesn't mean you won't get some corrections along the way to pull back to support. Maybe the 20-day, the 100-day moving average would provide a much better entry point to add exposure to portfolios than trying to buy right here. Now, here's the ironic part of this. If we can break out to new all-time highs, then retest that breakout of the move to all-time highs, that will also be a buying point. So again, sometimes, buying higher is okay because you've now got a reset of overvalued or overbought conditions, etc., to buy into versus where you were previously where things were extremely overbought. So again, that's really kind of we've worked through the markets here recently. Again, we've taken out all previous resistance levels at this point. The trend of the market is positive. Again, nothing really to be overly concerned about right now. But again, just as we start to move into September and we start approaching the election and earnings season, we may see a pickup in volatility. So again, just continue to manage risk. No reason to be, overly concerned about markets right now, but it never hurts to manage risk, rebalance portfolios as needed, and always have a little bit of extra cash on hand for opportunities when they do show up. That's what you need to know before the bell this morning. We'll come back, pick up with Michael Leibowitz right after the break, and talk about the FOMC and the Fed and interest rates. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. You need a blueprint to structure your funds against volatility and turbulence in the market. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint, Saturday, September 14th at the Hyatt Centric in the Woodlands. How to structure your savings, level your risk, and craft a secure future. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
At realinvestmentadvice.com.
So welcome to the show this morning. It is, of course, getting ready to wrap up the week. We're starting to roll into the end of the month, so kind of a lot of things going on, of course. Tomorrow is the big day for the Jackson Hole Economic Summit. Of course, that's where Jerome Powell will announce make his speech, and of course everybody's kind of glued to that, what he's going to say about potential policy, etc. But before we get to all of that with Mike Leibowitz, I just saw a really interesting chart this morning on life expectancy of different countries around the world, including the U.S., and also the differences between male and female life expectancy around the world. So clearly, we're doing something wrong here in the U.S. because if you live in pretty much in France or Italy, Spain, you're going to live a lot longer than you live in the U.S. Of course, a lot of that has to do with food and culture in general, less stress than we have here. But better food. Everybody walks everywhere. When you go on trips, etc., you see everybody just kind of walking everywhere they go. But And so that's great. And of course, women always live longer than men because we're just trying to figure out how to get out of our marriage. So are you still struggling, Brent?
I need you to turn your audio off on that computer.
Okay.
Just mute this YouTube channel.
Hang on a second. We're just having a small issue technically this morning that we're working through. Is that better?
Yes.
Okay, perfect. So you got everything squared away?
We're ready for Michael.
We're ready. So anyway, so I posted this chart this morning on life expectancies around the world, and if you are female and live in France, you now have the longest life expectancy of any group of people around the world. So I've figured out something this morning. I consistently diet. I stay on a very strict diet regimen. I stay on a very strict exercise routine. Michael Leibowitz knows that every morning I'm in the gym. And so he calls me while I'm in the gym and wants to talk about nonsense while I'm trying to work out. I don't know why, but he just has to do something. So I've decided today, though, that I am changing myself. I am now identifying as a French female, so I don't have to diet and exercise. This way I will just automatically live longer than all the rest of you. So it's just that easy these days, right? We just identify as something else, and we're all good. So I am now French and female, and there we go.
How's your French accent?
I don't know, but I'm gonna go eat a cake after the show this morning and chase it down with a couple of burgers and some fries. So I can't tell you the last time I had a burger and fries. So
That's living.
there you go. Of course, actually, Brent's trying to kill me this morning because he made me. He comes in, he goes, "Hey, I made you coffee." I'm like, "Oh crap!"
It's because you were late to the set yesterday.
Well,
making coffee.
You know what?
It's
Wait. They're not going anywhere. They're in the chat right now waiting for the show to start. We haven't even started the show yet. I'm just killing time so you can fix the technical issues over here.
Which was on your machine.
There you go. Well, you're the one that set it up while you were making my coffee. I tell you what, you set up my machine. Leave my coffee alone. There you go. Anyway. Michael, welcome to the show this morning. How are you?
Good. I like it when you pick on Brent, not me. Thank you.
There you go. No worries.
Happy to be of service.
Exactly. So, all right. Now that we've kind of got things put together, I apologize for the delay in getting the show started this morning. So, Mike, couple of things. Let's start with the FOMC minutes yesterday. I don't think there was anything. I read through the notes, and it didn't really seem to be anything surprising that came out. I think the only thing that was interesting is the one sentence where it says that it now looks to be appropriate to cut rates in September. I don't think anything else was hugely surprising. Did you see anything there?
No, absolutely not. They're raising rates.
They're going to raise rates. That's a surprise.
No, they're lowering rates. A large majority think now's the time to do it. There's still a few of them dragging their heels, but it seems, barring some kind of shocking unemployment data, they're going to go 25. If the data is really bad, they'll go 50. And I guess potentially if it's really strong and the CPI data that'll come out in mid-September is very high, maybe they won't go, but it seems like a done deal at this point. And this whole week is kind of a lot of information, but it's all known information. So you got Jackson Hole, and nothing has been leaked. Typically, Nick Timiraos at the Wall Street Journal will kind of be the Fed's mouthpiece and prepare the market for any kind of new news that the Fed may have. We've heard nothing from him. The Fed meeting literally had nothing. The job numbers were big, but Zero Hedge was out a week ago saying it's going to be 1 million. The Philadelphia Fed has been out saying that the numbers are wrong and potentially wrong by at least 500,000. So, it's kind of the market's just digesting things that it sort of knows already. So there really aren't any shocks. Actually, in the FOMC minutes, someone did say that they thought the unemployment numbers were not right. So the Fed certainly knows that too. Powell has also alluded to that. So
Which is kind of interesting, right? Because they do talk about, like, we've got strong jobs growth. We're data dependent, yet behind the scenes they know there's problems with the data, right?
Right, but they're getting data from a huge number of sources. Mm-hmm. So he's not saying we're data dependent to just the BLS. I mean, they're getting JOLTS data. JOLTS has been very telling, right? JOLTS has been, I can't say it's accurate, but it's told us that the jobs market has been slowing down for a long time. So has ADP. So, and JOLTS is produced by BLS. So I think the Fed knows that the job numbers and actually even the household survey within the employment survey has been very weak. So, I think this isn't news to the Fed, but my guess is had they known this, they probably would have eased already, and we'd be talking about a second easing now. So that's the case for 50 basis points. But I think this is, and I think that's why there was no market reaction, because it was kind of a known commodity. Whether it's 1 million or 800,000, I think is kind of irrelevant. It's just faulty data.
Yeah, and again, we've talked about, again, as I mentioned it kind of in the opening of the segment show, is that you and I have written articles about this. We've talked about this. One of the big problems is the birth death adjustment, which is it's literally a guess at how many businesses were started in a month and how many jobs that may have created. They have no data to support those adjustments, and those are always wrong by a very large degree. So there's significant problems with the collection. And again, you and I have discussed this before. One of the things that always kind of throws me a little bit is we actually have real-time sources of employment. We have ADP, Paychecks, these payroll companies that are literally every day processing hires, terminations, and payrolls for millions of Americans across, and the BLS is still working off a 60,000 person phone survey and some other data collection and a lot of mathematical adjustments. When you have access to real-time data on literally a daily basis, I mean, you could have a real-time employment indicator through the government.
And the survey is large companies. We're not talking about mom and pop companies. These are companies that have HR departments that it should be a survey, I guess, but it should be, you give us actual data, not what do you think happened this last month? How many people did you hire and fire? Yeah. So it's very perplexing, but this is like all government data. How long have we talked about rent prices being off? We know they're off. The Fed knows they're off. Everyone knows they're off, but everyone takes the CPI as gospel, knowing that 40% of it is just wrong. Right. So.
Well, and again, look, I understand a lot of this data, the way we used to collect it, 30, 40 years ago, as somebody made a comment in our chat this morning, is that you and I are now so old, we remember when the Dead Sea was just sick. And that's true, right? And back in those days, we had to get carrier pigeons to bring the data to us so we could analyze this stuff. But everything is online now. I mean, we have real-time access to all kinds of data. We track everything these days, whether it's hiring or firing or credit card spending or price data. Walmart just reported earnings. And one of the kind of more stunning statements that was in the Walmart announcement was that their use of AI has, the data, they can get data now and process the data on demand and spending and inventories and everything that's happening with AI that would normally take 100 people to do it. They can now do it with AI. So there tells you a lot about what AI is going to do to job growth. But they know what's happening on literally a second by second basis with inventories and pricing and demand and what's going out the door, what's coming in the door. Why we haven't changed our economic data collection, because we have these sources now of real-time data, it really kind of baffles me to a large degree. I mean, even Bank of America has real-time credit card spending data that they produce, every week, right? So, if B of A has it, why the government does it, I don't know. Maybe it's about job security if you work for the government. Anyway, all right, that's my ramble for this morning. I'll be back after the break. We'll pick up with Mike Leibowitz. Jerome Powell speaks tomorrow at Jackson Hole. What's he going to say?
And what's the market pricing in for Fed rate cuts now? Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. You need a blueprint to structure your funds against volatility and turbulence in the market. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint. Saturday, September 14th at the Hyatt Centric in the Woodlands. How to structure your savings, level your risk, and craft a secure future. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
You have to love Texans, and you have to love Texans back in the 70s because we didn't really know better. You take a big propane tank and you stick it in the back of your truck and make the connection to your car so that you have propane-fueled engines because propane was cheaper than gas.
The Real Investment Show podcast.
Gas was almost $1 a gallon. It was outrageous.
Same show, your schedule.
You were a mobile bomb, but
at realinvestmentadvice.com.
But you didn't have to pay for gas.
Oh, man.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint. Saturday, September 14th at the Hyatt Centric in the Woodlands. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So Jerome Powell set to give his speech tomorrow at the Economic Summit in Jackson Hole. Of course, this is the annual confab of world central bankers. They all get together and figure out how, it's kind of like Pinky in the Brain, right? It's, how are we going to, take over the world today? I'm not sure who's Pinky in the Brain, but, sometimes I think, Jerome Powell leans more towards the Pinky side of the equation. And there's people in the chat right now going, what's Pinky in the Brain? Go look it up. If you don't know Pinky and the Brain, you have missed one of the iconic cartoons of life, and you need to go watch some episodes of Pinky and the Brain. Mike is the brain, by the way. Let me just read to you a clip from the Wall Street Journal this morning because I think it's a good setup for what Mike and I want to talk about. There's a saying that economic expansions don't die of old age. They're murdered by the Federal Reserve. Federal Chair Jerome Powell has spent 2 years determined to beat inflation, even if it resulted in recession. Now he's on the brink of winning the battle without bringing down the economy. That's the hope anyway. If he succeeds and maneuvers the economy to soft landing, that brings inflation down without a big rise in unemployment. It'll be a historic achievement worthy of Central Banking Hall of Fame. For Powell, the last phase of the Fed's inflation fight marks a make or break moment. How he plans his approach will loom over the central bank's annual conference, which is what's going on right now, at Wyoming's Grand Teton National Park, including the widely anticipated speech on Friday. Now, interestingly enough, when Powell spoke 2 years ago at that conference, 15 minutes before he was supposed to give a speech, he tore up his speech and wrote a whole new speech. And that was because markets were rallying strongly into that speech, expecting the Fed to start cutting rates. Or, well, not cut rates, but at least to stop hiking rates at that point. And we were nowhere near ending the fight of inflation. If you go back and look at September of 2 years ago, the market was accelerating higher. As soon as he gave his speech, the market accelerated lower, and we went down to new lows during that kind of corrective cycle during 2022. So what's he going to do here? Market's been up. NASDAQ's up 11% in 10 days. The S&P is about to broach all-time highs. A lot of this driven by expectations that the Federal Reserve is going to announce they're going to cut rates. Expectations are now that they're going to cut by a full 1% by the end of the year. So, Mike, what do you think? You think Jerome Powell may tear up his speech and write a new one 15 minutes beforehand?
No, I think he's actually okay with the stock market rising this time. This time is very different than 2 years ago. Inflation is tame, right? It's still a little high, but there are certainly measures of inflation that are below where they were before the pandemic as well. So I think the Fed is not very, but somewhat confident that inflation has gotten close enough back to target and is still heading that way. And at the same time, they're concerned a little bit about the employment market. And I'm sure the Fed always has recession in the back of their mind, that we run the risk that if we keep rates too high for too long, that we're going to have a recession, and we don't want that. So, the Fed really believes that higher stock prices stimulate the economy. And there's a lot of validity to that, right? We all feel better when our 401ks are larger, when our brokerage accounts are larger, and we spend more. So my guess is he'll be somewhat friendly. It just doesn't seem like there's much for him to say that hasn't really been said by the Fed. Typically, we would expect him to kind of come out and really talk about what they want to see to get Fed funds down, where they want to get Fed funds to, what's the right rate for Fed funds, and provide something new or different. But it's hard to see that there's going to be anything new or different that comes out of his speech tomorrow. Or there's a lot of speeches over the next, I think, what is it, today, tomorrow, and Saturday, or and Sunday maybe?
Yep. Yeah, but again, nobody cares what, somebody from the ECB says. It's all about the Fed, right?
But there have been times where, either other Fed members or others, some bankers sometimes, they do say things that are off script.
Right.
And that does kind of pique the market's interest. But again, I think this one is pretty cut and dry. I think we all know what the Fed is thinking. The Fed, the Fed funds market, the futures market, is right on par with sort of what the Fed is thinking. So your ability to shock the market would involve the Fed saying, no, we're going to cut a lot more. And there's no reason for them to do that. They're going to probably take this in a very measured approach and start doing 25s at each meeting and see where it takes them.
Yeah, there is a more than just a small contingent of people expecting a 50 basis point cut, in September. But again, the data really, inflation is still, it has come down a lot. And again, let me be really clear here for you listening to the show. What Mike and I are talking about is that when we talk about inflation coming down, again, as we said before, what the market cares about is what the data says, not your personal experience. And yes, Mike and I go to the grocery store, we buy gas. But as we talked about before, Mike pays a whole lot more for gasoline than I do here where he lives in Maryland versus where I live in Houston. So his experience with inflation, his home prices in Maryland are a lot higher than they are here for the same house. So his experience with inflation is far different than mine. So again, that's our personal experience, as we said before. When we talk about inflation coming down, being below 3%, heading towards Fed target, that's what the market cares about. So again, don't come at me, bro, about your personal experience in inflation, because what we're talking about is what the markets care about. But Mike, there is a contingent of people expecting a 50 basis point cut because of that employment revision yesterday. But I don't really see him going that aggressively. I think that might actually shock the market. The market might take that negatively because all of a sudden the market says, oh, things are maybe a lot worse than even what we thought it was.
Yeah, I agree 100%. If he goes 50, assuming employment number is fine, next Friday, then I think there will be some, what does he see that we don't see kind of thing. But I think it's really important. Back to your inflation rant there a little bit. Yep. Look, everyone knows that prices are 20, 30, 40%, even more for some things higher than they were in 2020. The Fed tells you that. Everyone knows that. All they care about is how much is it changing? How much did it change over the last 3 months, over the last month, over the last 6 months? And, I know we all have some preconceived notions in our head about inflation and its prices are so high, but prices really are not moving up that much on a month-over-month basis. They're really in line with the Fed target. So it's very hard for consumers to see it. But that is what's going on. So the Fed doesn't care that they're 20% higher. That ship has sailed, and they're not going to bring that ship back to port. What they care about is what's the month-to-month and year-over-year rate of inflation.
Right.
So, you can disagree with that all you want. The Fed doesn't care. The government doesn't care. It is what it is. And as investors, we have to accept that, and we have to understand why they think that way, appreciate the way that we think, that you as an individual think about inflation, but you kind of have to move on, and you have to put yourself in Powell's seat and appreciate what he has to do and what he sees and what he's trying to manage. Mm-hmm. And it's very difficult for a lot of people to do, but that as an investor, you have to wear certain blinders, and that's one of them.
Right. And somebody in our chat made an interesting comment, Mike. It says inflation is compounding. Yes, inflation compounds.
Yep, absolutely.
And, the idea, and again, as we talked about before, the Fed does not want deflation, right? So that's negative price growth. So when you talk about deflation, that means things are going actually down in price. The Fed doesn't want that because deflation, is a psychological issue on a consumer basis. Because once prices become negative, then consumers start to wait for prices to fall further before making a purchase. And that becomes a psychological loop that continues to drive prices lower. That's a very difficult cycle to break when you get into deflation, and it's economically extremely damaging. The Fed does not want deflation. They just want lower rates of inflation. They want prices to go up at 2% a year. And this is why, if you're expecting food costs to go down, that's not going to happen because inflation, there's two things that happen with prices. First of all, if a company sells a good or a service at a certain price and it's gone up in price because of inflation, they may not hike prices anymore, but it's unlikely they're going to cut those prices dramatically in the future. And this is why gasoline used to be $1 a gallon. And even when you had negative oil prices in 2020 or 2021, whenever that occurred, I think it was 2020, when you had negative oil prices, gasoline prices didn't go back to $1, right? They came down some, but they never revert back to where they were previously. But this is the thing with inflation, is that inflation goes up every year. Deflation has occurred, but in very bad economic environments, which you really don't. Some inflation is a lot better than deflation. Trust me, economically speaking. Be right back after the break. We'll conclude our conversation here with Michael Leibowitz. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. You need a blueprint to structure your funds against volatility and turbulence in the market. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint, Saturday, September 14th at the Hyatt Centric in the Woodlands. How to structure your savings, level your risk, and craft a secure future. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Let me just clarify one thing about our inflation conversation. And Mike, I know you'll want to weigh in on this too. We'll keep it short because we just want to kind of wrap up with our conversation about the Fed. But in the chat, everybody's going on about technology stocks and others, technology, etc. Prices on individual items, like say television. I'll give you a good example. So I'm building a new office in the house we're remodeling, and so I just bought TVs for the house. One of the televisions is brand new technology, right? I wanted the I just bought the latest, greatest, TV for aspects of what I need in the office for backdrops and all this other type of stuff we're going to be doing, making videos for Simplivisor. I bought a similar size TV that was a year old. Didn't have all the latest, greatest technologies. It was about 1/3 of the cost. And so there are items that become outdated very quickly. And that's the issue with technology in general. Computers, laptops, phones, those type of things. There are new devices coming out every single year. And so that's what everybody wants. So those prices remain high, very short term, and then begin to drop as new technology comes out. Go to the grocery store as an example. You'll find items that are on sale because they're getting closer to their expiration date. So I've got to get, these steaks, I've got to get them out the door because I don't want to eat the inventory, right, from a business perspective. So I slash those prices on those steaks that are going to be, out of date within a few days, right? But my new fresh steaks that I just cut and put in the meat counter, those are much higher priced because they're now fresh, right? That's the new stuff. So supply and demand drives prices. And look, inflation is a function of supply and demand. So yes, prices are moving on things all the time. And yes, some prices are going down, some prices are going up because of changes to demand for that good, service, or product. But in general, as we were talking about, inflation in general is going to rise and compound over time, and that's good. Now, look, you don't want runaway inflation, right? You don't want 9-10% inflation because that basically kills the consumer. But you want some inflation because that means the economy is growing. Mike, comments?
Well, the other side of that equation is that the economy is compounding. GDP growth compounds. Our wages compound. So you never hear the argument, oh, the price of bread is up 20%, but it doesn't matter because so is my earnings. But that's what's been going on. Earnings have more or less, and it's obviously different for everyone, and what everyone consumes is very different, but earnings have largely kept up with prices. It's not like we're 20, 30, 40% in a hole from where we were in 2019. So, again, economists don't always look at things the way we look at them, but there is some rationality to wanting inflation, to wanting it to be low, but you want inflation over deflation. And one of the big arguments is actually debt. We're a very heavily indebted society.
Correct.
So it's easier to pay off debt when you have inflation. If I make $100,000 and I borrow $100,000, that's a 1-for-1 ratio. Well, a year from now, I may be making $105,000. The debt's only $100,000. So as incomes and the amount of GDP, the amount of wealth the economy produces rises, the old debt stays the same, making it easier to pay off. So that's another big reason why the Fed doesn't want deflation, because deflation works the opposite way. And given how indebted we are as a country, individuals, and even corporations to some degree, it's very problematic.
Right.
So the Fed's, we think about the Fed trying to get this perfect Goldilocks economic landing. They're very much trying to get a perfect Goldilocks inflation landing. They would love it to sit just at 2%. Remember, in 2021, when there was massive stimulus already and when the supply lines were shut down, the Fed was begging for inflation. So we may not be that far off from where the Fed is once again. And they were begging for the last, going back to Yellen and Powell before COVID. They were all saying we want a little more inflation. We need a little more inflation. We may not be that far off from them saying, it's not going to be politically palatable. But in various ways, they may be a year or two off from saying we want more inflation, not less.
Right. And again, there was a comment in our chat talking about deflation would be great for people, not so much for asset holders. No, deflation is terrible for people. You will not have a job in a strongly deflationary economy. Yes, prices are coming down because companies are trying to liquidate inventories. That's why prices are coming down. They're going to be liquidating inventories and cutting jobs and laying off people en masse because there's no demand for the business. So no, deflation is terrible for the average American. Don't conflate just higher or lower prices and as an isolated event. You have to look at all of these aspects as to how it translates into the economy. As Mike said, if inflation is rising, that's because the economy is growing, companies are making more money, there's demand for that good service that they produce. They hire more employees. As they hire more employees, that increases wages over time. And yes, wage growth hasn't kept up with the inflationary spike that we had that was driven by the stimulus. But again, over time, wages, and I showed you this chart just, I think, on Tuesday, of wages, inflation, and economic growth, and there is almost a perfect correlation between those three items. And so Mike's absolutely right. Wages and inflation have a very high correlation with each other. Okay.
And so,
go ahead.
Well, real quick, someone just had a really good quote on YouTube. He says, "Don't hear anyone wishing for wage deflation."
Yeah.
And that's exactly right. Because if you get price deflation, you're going to be getting wage deflation. So pick your poison.
Yeah. Sometimes, yeah, it just, but again, and this is why the Fed's mandate is price stability. That's inflation. They don't want 9% inflation. They don't want 10% inflation. They want inflation that translates into stable economic growth over time. And that's their goal. Ultimately is full employment and price stability. That's their two primary mandates. And so, yes, they want inflation. But anyway, enough of that. Let's finish up the show here. So speech tomorrow from Jerome Powell. Don't see any really big surprises coming out of that. Fed rate cuts rates potentially in September. That looks like that's pretty much a done deal. Fed funds futures, I think, are 100% now on that.
Yeah.
Any other expectations coming out of that meeting or anything we should be aware of, particularly relating to the bond market?
Maybe QE, QT. They're going to talk about what they're planning on doing with QT. Maybe they're going to put out some sort of schedule, but not much. But, going back to Powell, again, typically if there's anything kind of unexpected, they will leak it through the press, through the Wall Street Journal. And we haven't really seen anything to that effect. So either Powell's going to walk the line and he's going to kind of tell you what we know already, or he's using this sort of like what he did 2 years ago to really shock the market with something, because he doesn't want it leaked. He really wants to surprise markets, which the Fed never really wants to do. So that's kind of the other outcome I assign very, very low odds to. And I guess, Lance, the third thing is, will he talk about the Bank of Japan and what they're doing and the linkage between the markets and the value of the yen versus the dollar? Because that's a big deal for markets, and it feels like it went away, but that carry trade is still out there. And it's a $15-20 trillion trade. So even though it's not in the headlines anymore, it's an issue. And we're in an environment where the Fed is cutting rates and the Bank of Japan is potentially raising rates. In fact, they have a CPI number coming up in a week or two and a Bank of Japan meeting. And if that inflation number is high, they could be talking about more rate increases, which could roil the currency markets. And we saw what happened the last time they did that. So any comments he has on the Bank of Japan will be pretty helpful for the market as well.
Yeah, there was a really interesting chart out this morning talking about the yen carry trade. And I believe it was from either Bank of America or Deutsche Bank. I can't remember which one. But basically showing that there is now, over the last 10 days, this big market rally, and the S&P has really, there's normally a very high correlation, as would be expected, between the yen carry trade and the markets. And while the market has been rallying over the last 10 days to a very large extent, the yen carry trade has not. And so there's a very big gap now between the S&P index and that yen carry trade, which either that yen carry trade has to catch up with the market, which it would logically, you would think it would, or the market's going to have to correct to come back down at some point to realign with that carry trade, because there's so much of the market transaction that works off of that carry trade. It's something at least worth paying attention to.
Right. The other thing to keep in mind, both stocks and bonds are pretty overbought here. So Powell may say something that we would, if we heard it today, we'd say, yeah, that's exactly what we expect. The markets, both stocks and bonds, yields could rise, stocks could fall on whatever he says, and the press on Saturday morning will say, oh, here's the market didn't like what Powell said. They're very overbought right now and just due for a technical correction. Yep. So, always be careful trying not to read too much into a market move based on a few headlines that are, not market related.
Absolutely. All right, Mike, thanks so much. All right, that wraps up the show for the day. Michael's new article is out on the website today. It's actually yesterday, but it's there for you today. So simply go by realinvestmentadvice.com. Get Mike's latest article, along with all of our articles. Our newsletter will be out this weekend talking about really kind of some of these bullish indicators that are really not only supporting the current rally, but are really undermining a lot of the more bearish media headlines that are out there. Worth paying attention to, and that'll be covered in this weekend's newsletter. It's all at the website. It's all free, of course, to help you manage your money better. realinvestmentadvice.com. Have a great day. Be sure and like and subscribe to the channel. We appreciate it very much. And Richard and Danny will be here tomorrow. I said that last week and they weren't, but they will be here tomorrow for Financial Fitness Friday, along with Brent. He'll be here too. All right. See you tomorrow.